Welcome to the Deep Dive. Today we're jumping into the latest results from Brinker International. You know, the company behind Chili's and Maggiano's.
We're looking at their Q4 Fiscal 25 earnings and also their guidance for Fiscal 26. It's quite a story.
Yeah, really a comeback narrative. So our mission today, unpack those numbers, figure out what's driving this and what it might mean going forward.
Exactly. Give you the key insights from their reports, their call, and really show why this is such a compelling case study in casual dining right now.
Okay, let's get right into it then. The Q4 numbers, they really stand out, don't they?
They absolutely do. Total company sales hit near the $1.45 billion. That's up quite a bit from, what was it, $1.19 billion last year?
Yeah, massive jump. And total revenues at $1.46 billion, actually beating what the analysts expected.
Right, and the earnings per share, the adjusted EPS, came in at $2.49.
Yeah.
That also beat the consensus pretty handily.
Which the market definitely liked. Saw Brinker's stock jump over 6% in pre-market right after the announcement.
Yeah, that's a strong signal. It shows real confidence, not just meeting expectations, but significantly exceeding them. It speaks volumes about their execution.
But okay, the headline is big, but the real story, I think, is Chili's. I mean, wow.
Oh, absolutely. That's where it gets really interesting. Their Q4 comparable restaurant sales, they jumped an incredible 23.7%.
23.7%. That pulled the whole company's comp sales up 21.3%.
And the CEO, Kevin Hockman, he didn't mince words. He actually said, Chili's is officially back, baby, back.
Ah, love that. He also pointed out sales up 24%, driven mostly by traffic, right? Up 16%.
Exactly. Traffic up 16%. And this isn't just a one-quarter blip. That's the key thing here.
Right. What are the longer-term numbers looking like?
Well, they've got 2-year sales growth of plus 39%, and 3-year sales growth hitting plus 45%.
45% over 3 years. That's sustained momentum.
It really is.
Yeah.
And get this, they've beaten the industry on traffic for 7 consecutive quarters.
7 quarters in a row.
And achieved their 17th consecutive quarter of positive same-store sales growth.
Okay, 17 quarters. So this is clearly not a fluke. It's something structural they've changed.
Definitely. And you see the impact directly in their unit economics. The average unit volumes, the AUVs for Chili's.
Yeah.
They're up to $4.5 million now.
Wow, $4.5 million. What were they before?
They were at $3.1 million at the end of fiscal 22. So a huge increase.
That's massive. And what about profitability? Margins?
Also improving. Brinker's overall operating income margin rose to 9.8% in the quarter, and the restaurant operating margin, the non-GAAP one, hit 17.8%.
And that's up year over year.
Yep, a 2.6% improvement compared to Q4 last year. So more sales, and they're keeping more of it, is profit per restaurant.
So more people coming in, spending more on average, and the restaurants are running more efficiently. That's kind of the trifecta.
Pretty much. It shows the strategy is working on, well, multiple levels.
Okay, so let's unpack that strategy. How did they actually do this? What were the key pillars?
Right, so they focused on a few core areas. First, food and menu innovation. Big one.
Like the ribs you mentioned earlier.
Exactly. They relaunched the ribs platform. They said customers are, and I quote, raving about the look, the size, and the taste, calling it a very noticeable upgrade. It's meant to drive traffic, bring people in for a core Chili's item. Makes
sense. Go back to your strengths.
Yeah.
What else on the menu?
The new frozen margarita program, they upgraded to a premium patron base, got new Taylor Marg machines for better texture, bigger capacity.
Okay. And how's that doing? Sometimes premium upgrades are tricky.
Apparently it's working incredibly well. They're selling nearly twice the number of frozen Margs, even though they raised the price significantly to $10.
Wow, double the volume at a higher price. That's impressive. They mentioned some new flavors too, right?
Yeah, the Flamingo Freeze and Arctic Drift. Catchy names. It shows they're thinking about the whole experience, not just the drink itself.
And value is still part of the equation, though.
Oh, definitely. The Big QP campaign at 10.99 cents, that was all about reinforcing Chili's as a, quote, restaurant value leader.
Right, I remember seeing stuff about that. They did some kind of fast food financing launch event.
Yeah, that generated a lot of buzz. It's that barbell strategy, offer value that also have premium options people are willing to trade up for.
And behind the scenes, they simplified things.
Menu simplification. They cut a net of 10 pantry SKUs, ingredients, and 8 actual menu items.
So fewer things for the kitchen to manage.
Exactly.
Yeah.
Allows the teams to, as they put it, focus on making fewer things better. Quality and consistency.
Okay, food and menu. What's pillar number 2?
Operational improvements. This is huge. They got new Turbo Chef ovens installed in all the restaurants.
Replacing older equipment.
Yep. Benefits. They say less heat in the kitchen, cooks faster and more evenly, more reliable, easier to clean, and crucially, it helps get that, quote, delicious bark on the new ribs.
So the equipment directly enables the menu improvements.
Precisely. It's all connected. And it's not just equipment. Big investment in labor, too.
How much are we talking?
Over $160 million more invested in labor since fiscal 2022.
Wow.
And repairs and maintenance, over $100 million incrementally spent in the last 3 years, basically catching up on stuff that had been put off.
So nicer restaurants, better equipment, more staff support.
Right. They claim the estate has never been in better condition, foundational stuff that impacts the guest experience every single day.
Okay, so food, operations,
What else?
marketing, world-class marketing as they call it, and they backed it up with dollars.
Yeah, I saw that number. The
Yeah.
budget went from like $32 million in fiscal 22.
To $137 million in fiscal 25.
Huge increase.
Yeah,
And it seems to be working. They got some recognition.
they did. Ad Age named them 2025 Brand of the Year, so the message is cutting through.
Okay, so better food, better ops, telling people about it effectively, makes sense. And all this while managing the finances. Seems so. They've really focused on strengthening the balance sheet. Paid down over $570 million in debt over the last 3 years.
That's significant debt reduction.
It is. And it got their lease-adjusted leverage ratio down to 1.7.
Okay, can you unpack that ratio for us
Oops.
quickly? What does 1.7 mean?
Sure. It basically measures their debt relative to their earnings, factoring in lease obligations for their restaurants. A lower number is better, means less risk. 1.7 is considered pretty strong, especially in the restaurant industry.
Got it. So financially healthier.
Yeah. And they paid down another $90 million on their revolver, their credit line, just in Q4. Plus, the board added $400 million to the share buyback authorization.
So they feel confident enough to return more cash to shareholders.
And they extended and increased the revolver line to $1 billion out to 2030. So they have plenty of financial flexibility, ample liquidity, as they say.
All right, so Chili's is clearly the star here.
Yeah.
But Brinker also owns Maggiano's. How did they do?
Yeah, Maggiano's,
Very good.
well, it's the other side of the coin right now.
Yeah.
Their Q4 comparable sales actually decreased by 0.4%.
Oh, okay. So basically flat to slightly down while Chili's is booming.
Exactly. It highlights that these are distinct brands with different challenges, and they've made a leadership change there.
What did they do?
The main Brinker CEO, Kevin Hockman, he's now also overseeing Maggiano's directly as interim president. And they promoted Rich Kissel, who was a successful VP of Ops at Chili's, to be the COO of Maggiano's.
So putting some of the Chili's turnaround talent onto Maggiano's suggests they think the playbook might be adaptable.
It certainly looks that way. They're calling it the Back to Maggiano's plan.
Okay. And what does back to Maggiano's mean?
It means focusing on the brand's core, what people traditionally loved about it. Delicious Italian-American favorites, abundant portions, an inviting atmosphere for groups.
So less focus on maybe trying to be something it wasn't. I remember hearing talk about elevating the experience there before.
Right. It seems that might have caused some disconnects. Now the focus is squarely on what the core Maggiano's guest values. Scratch-made Italian classics, big portions, feeling like it's their local restaurant.
Kind of like the Chili's approach. Figure out your core strengths and nail them.
Pretty much. And the big part of it is, quote, listening to restaurant leaders to improve service and ops. Again, very similar to the groundwork at Chili's.
Interesting. It'll be one to watch, see if they can replicate this success. Okay, let's pivot to the future then. Fiscal 2026 guidance. What are they telling us?
They're projecting total revenues between $5.60 billion and $5.70 billion.
And earnings?
Adjusted diluted EPS between $9 and $10.50.
How does that stack up against expectations?
Generally above what analysts were forecasting. So they're signaling confidence that the momentum continues.
Right. And they're still planning to invest heavily. CapEx.
Yep. Capital expenditures expected between $270 million and $290 million for fiscal 26.
So for you listening, this basically means management isn't resting on its laurels. They expect continued growth and are putting money behind it.
Exactly. They see more runway ahead.
So what specific initiatives are planned for 26 to drive that? Let's start with the food pillar again.
Okay. For Chili's, you get a full year of those upgraded ribs we talked about. Plus, upgrades to queso and nachos coming in Q2, they're aiming for the, quote, best tasting queso.
Always a crowd pleaser, queso.
Isn't it? Also, a major relaunch of the chicken sandwich platform in the second half of the year, a full year of the new frozen marg program, and they mentioned a lineup of $6 margs of the month.
$6 margs. That hits the value side of the barbell.
Precisely. And they're even investing in better background ingredients,
Mm-hmm.
premium mayo, ranch, bacon bits, 50% thicker bacon, just continuous quality upgrades.
Okay, makes sense. How about the operations pillar for 26?
4 quarters of simplification rollouts, so continuing to streamline. Implementing learnings from their top-performing restaurants, what they call North of Six initiatives.
Ah, the ones doing over $6 million AUVs.
Right, applying those best practices more broadly. They're also rolling out new labor scheduling tools and really trying to foster a culture of manager ownership, embedding that operational excellence.
And you mentioned they're playing offense on atmosphere now.
Yeah, the remodeling program. Plan is to remodel 10% of the Chili's fleet annually, so restaurants get refreshed every 10 years. The first 4 test remodels using their modern Greenville reimage package should be done by the end of this calendar year.
Learn from those and then scale up.
That's the idea. And they hired a new VP of Restaurant Development, Richard Ingram, to lead both the reimages and also accelerate opening new restaurants. So growth mode.
Okay, that's a clear shift. What about technology? Any big moves there?
Yes, a pretty significant one. They're dramatically simplifying the server handheld iPad app,
How so?
making the design more intuitive, removing over 700 unused skis from the back end.
700.
Yeah, making order paths faster. The estimate will save hundreds of millions of less taps annually across the system.
Wow, that sounds small, but aggregated across all servers, all shifts.
It adds up. Should improve accuracy, speed, maybe even help with server turnover if the tool is less frustrating. It'll also have seamless offline mode and make splitting checks easier.
Those are real quality of life improvements for staff, which usually translates to better guest experience too.
Absolutely. And they're boosting the infrastructure behind it, upgrading internet and Wi-Fi, adding cellular backup, higher speeds, thousands of new Wi-Fi access points for better coverage in the restaurants.
So investing in the tech backbone, it all sounds good, but how do they balance pouring all this money back in while still delivering profit growth?
That's the balancing act, right? They're pretty explicit about it. They plan to let strong sales flow through to profit while continuing to reinvest significantly.
They gave specific numbers for FY26 investments?
They did. About $12 million more into Chili's food quality, $2 million into Maggiano's food, another $17 million in incremental labor for Chili's, and $4 million for Maggiano's labor.
So tangible reinvestment plans.
Yeah. Their philosophy seems to be that reinvesting profits back into the guest and team member experience is, quote, the secret sauce. They believe it drives sustained success, a better experience, and ultimately gives them pricing power. It's a long-term view.
Okay, let's dig a bit deeper now. Big question. Is this growth sustainable, or is this just a post-pandemic rebound meeting some smart marketing?
It's a fair question. The CEO argues it is sustainable because of the foundational changes they've made. You know, the higher AUVs, better margins, the simpler menu, the investment in labor, better equipment, upgraded tech, stronger balance sheet, bigger marketing budget.
So they're saying the underlying business is just fundamentally stronger now.
That's the argument. It's not just one thing, but a whole system overhaul.
What about the customers themselves? Who's coming into Chili's now?
This is really fascinating. They said they're seeing growth across all income levels, low, medium, and high.
All levels. That's interesting. Usually you see shifts like trading down.
Right. It suggests the appeal is broad. Maybe the value hits the lower end, the premium options hit the higher end, and the overall experience works for the middle. Hard to say exactly, but it's broad-based growth.
And are these new customers sticking around? Or just trying it once?
Another interesting point. They said despite a huge influx of new and lapsed users, customer frequency is actually staying flat.
Okay, wait. Flat frequency with lots of new people? What does that imply?
It implies the new folks are coming back just as often as the existing guests, which suggests they're having a good experience on that first or second visit and deciding to return. It's a good sign for retention.
That points to the operational improvements really landing with guests.
Okay.
And pricing. Are they just going to keep raising prices with this demand?
They plan to continue what they call their barbell pricing strategy. Protect the value end, those $10.99 deals, the $6 marks for people who need it, but also offer more premium options for those willing to pay.
So tiered pricing, essentially.
Yeah. For FY26 overall, they expect pricing to be closer to 3%, tapering off through the year. But they emphasize flexibility to adjust if needed, not just aggressive hikes across the board.
Got it. One last thing on the menu strategy. They talk about the 5 to thrive.
Right, that evolved from their core four items.
Hmm.
It's burgers, crispers, fajitas, margaritas, and now the triple dipper appetizer.
And those are still driving sales.
Hugely. The triple dipper alone is still 15% of sales. The whole 5 to Thrive group continues to grow its share of the sales mix.
So the core is strong. What's the next step then?
The strategy now for the next 3 years or so is to upgrade the balance of the menu, to bring the quality and operational consistency of everything else up to the level of those 5 to Thrive items.
Ah, so ensure that if a new guest, attracted by the buzz, tries something other than the core 5, they still have a great experience.
Exactly. Make the quality consistently high across the board,
Eh?
which seems smart for keeping those new and lapsed customers coming back.
It really raises a question, doesn't it? For any business, really. How do you revitalize a mature brand? Brinker's answer seems to be this intense focus on core strengths combined with relentless operational refinement.
Yeah, fixing the fundamentals, but doing it comprehensively.
Okay, let's wrap this up. Key takeaways. Brinker's had a stellar Q4, mostly powered by an incredible turnaround at Chili's.
Mm-hmm. Driven by strategic moves in food, operations, marketing, and supported by a healthier balance sheet.
Maggiano's is a work in progress, but they're applying similar principles there. And the guidance for fiscal 26 suggests they expect this momentum to continue, fueled by ongoing investment.
Right. Reinvesting profits back into the experience seems key to their philosophy.
So the final thought for you to consider, what can you take away from this deep dive? Maybe it's a reminder that even in tough, established industries, you can engineer a major comeback.
Yeah, it really underscores a relentless focus on the fundamentals. Product quality, operational efficiency, your people, your tech, your physical spaces can make a huge difference.
It's not always about flashy new concepts. Sometimes it's about meticulous planning and just executing the basics exceptionally well. That seems to be the Brinker story right now.